Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. And today, we're diving deeply into how options are priced. When we purchase an option, what is it we're paying for, and how might that price change? What are the influences on things? We're going to be looking specifically at something known as the options Greeks. So this is going to be Options Greeks for beginners, introducing Delta, Gamma, Theta, Vega, and a little old Greek named Rho. A lot to discover. We're gonna determine just exactly how important these Greeks certainly are in the trading of options. We're even going to be examining these using a real-time example today. So a lot to be learned. Before we get to any of that, though, let me first of all say hello to everybody started chatting in. Great to see all the familiar names out there in YouTube. Hello there, Ruggs and Jay Richardson, Bill, David, Eva, Ricebird, Greg, Lawrence, Josh, JB52, on and on that list goes. Thanks for joining me today. I always appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream has concluded, well, enjoy that recording, but be aware that you're invited to join us in the live webcast. This is a Tuesday webcast series. We kick things off promptly at noon Eastern time. We'd always love to have you here as a live stream audience member. Rugg says I'm in the beginner stage and I need all the first step information that I can get. Excellent. I think that you're not alone. There are going to be probably 150, 200 people that watch this live stream. Probably many hundreds or thousands more that see this on the rebroadcast on the recording. And so I'll try to go at a pace that everybody can follow. There are going to be lots that are brand new to this. All right. Now, I also want to let everybody know, if you have an account with X, you should be following your favorite Schwab presenters there on X. You can find me there on X at Cameron May CS, and it really is the best place to connect with me. If you reply to one of my posts, I try to reply right back to you. So let's get into this discussion. Greeks for beginners, we'll call it that. But in any case, as we do, of course, there is some important risk information that we need to bear in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as sole means of investment research. And investing involves risks, including the loss of principal. All right, so let's set an agenda for today's discussion. And I think this is an important discussion, especially for somebody that's new to options trading, because it can be a little bit bewildering to understand how options work. When we buy a stock, if the stock goes up $1, well, we just made $1. If it goes back down $1, we lose that dollar in unrealized gains or losses. But with an option, when we enter into a contract, there are a series of variables that determine the value of that contract at the moment that we purchase it or we sell it. And those same variables influence the changing value of that option at the time we choose to exit. So we really need to understand that. The way that we gauge those variables is through using something known as the options Greeks. Now, whenever I say the phrase Greeks, it can sound like we're going to be learning a different language. I'll try to make this as digestible as possible. Try to go at a pace that everyone can follow. But we're going to be learning about 5 options Greeks today: Delta, Gamma, Theta, Vega, and even little old Rho. Yep. So let's go right to the Thinkorswim platform, and we're going to look at these through a current lens. And I want to kick things off here with a discussion of Bank of America. Now, I chose this stock for a very specific reason. Number one, well, a couple of specific reasons. It's a lower priced stock. And that just having small numbers is going to make the math easier to follow. Number two is a trader might be looking at what's been happening with the price chart in the planning of an option trade. So what we're going to be doing today is we're going to put ourselves in the shoes of a potential options trader. Maybe they're considering buying a call option. And then we're going to discuss how today's call option is priced and how that price might change over time. Okay, so let's just take a look at what's going on with the chart. And maybe our trader has noted that Bank of America has been running up just like so many other stocks. It's been making higher highs and higher lows for the most part since that first or second week of April. it's tended to run up and pull back and run up and pull back and run up and pull back. And so within what appears to be an intact upward trend over the last week or so, looks like we pulled back from recent highs around maybe 52 and a half up to maybe $53. And Rug says on my iPad, the screen doesn't look like yours. Yes. So just be aware, Rugs, that there are actually 3 different versions of Thinkorswim. I'm using the Thinkorswim desktop software that can be downloaded free of charge from within your online account. Just schwab.com. You can go to the trade tab and download Thinkorswim. Now, there are 2 other versions. There's Thinkorswim Mobile, which is an app that can be downloaded to a portable device, or there's Thinkorswim Web, which is a browser-based version of Thinkorswim. Web and mobile are sort of streamlined versions. I'm using a full-blown desktop software version. This is the most robust version, most detailed. Certainly looks a little bit different in its interface than some of the other 2. Plus, I've changed my background color scheme from a dark scheme to a lighter scheme. So that could explain what's going on with the differences if you're seeing a different looking chart, different looking platform. But let's say that our trader here sees that our stock has been going up. It's recently pulled back from those highs down to recent lows around that $50 level. And maybe they just think that that's going to be a price floor or price support. And let's say that they're expecting price to rally, maybe back up to 52 and a half, maybe to $53. It's a very basic view of the chart. I don't want to focus on charting today. Instead, I want to talk about option pricing and the Greeks. Okay, so let's go place an example trade for a long call option. So let's just say maybe our trader sees the stock has been running up over a relatively short period of time. If you'll notice, we went from 50 up to about 52 and a half in about a week. And let's say the trader is expecting about that size of a move in about that time frame again. Maybe they're going to go enter into a short-term contract. If we think it's going to take a week to get up to our price target, maybe we buy 2 weeks to make sure that we have sufficient time. So let's go to the trade tab. And our 17th of October contracts expire in 10 days. That's only a week and a half. I'll use that as today's example, though. Let's say that we go for that 17th of October expiration. And with the stock trading right around $50, I think for today's example, how about we look at that $50 contract? So we're buying a $50 call, giving the trader the right to buy 100 shares of Bank of America at any time for the next 10 days. And they can buy those 100 shares for $50 per share. Now, if you look at that right now, that's priced $1.32 to $1.36. Let's call it about $1.34. I'm gonna jot this down over here. So this is our example trade, and let's make this bold. For to make it bold, it's just easier to see. Example trade is a long call, and we're going to buy the 17th of October, a 25 call. We're saying still around $1.34. You'll see that changing. And actually, that's important because we're going to be talking about what is influencing the change of price. Okay, but I first of all want to talk about what is this $1.34? What are we paying for? Well, we're paying for, first of all, any discount on the stock. This is what we're getting. $1.34 that we're paying consists of what's known as the intrinsic value plus the extrinsic value. The contract. The intrinsic value is that, well, you're right now paying $1.34, and that gives us the right to buy the shares for $50. Well, the shares are already worth $15.18, so there's a little bit of a discount that we're getting there. We refer to that as the intrinsic value of the contract, or the sort of the day one advantage over the current market price. So in this case, our intrinsic value is about, we'll call it 17 cents. Well, where does the other money go? We paid $1.34. There's $1.17 that's not accounted for here. That's what's known as the extrinsic or the time value of the contract, because we have the right to buy the shares for $50 right now on day one, but that right extends all the way through the next 10 days. So if this stock goes to 52, 53, 55, $60 over the next 10 days, I'm not saying that it will, but that's certainly within the realm of possibility. That trader still has the right to buy it for $50. So those 10 days carry potential. They carry potential for significant appreciation in the value of this contract, or in other words, significant appreciation in the intrinsic value of that contract. So we call that the, let's see, you're right, Josh. Thanks for calling this out, Josh. Which strike price did we choose? The 17th of October. Let's just know that we're talking about 2025. I'm going to replace this with a strike. There we go. 17th of October, $50 call, $4.34. Is that a little bit easier to read? My apologies if there was some confusion there. So we're paying for the current discount on the stock, but we're also paying for the future potential discount on the stock. That's known as the extrinsic or the time value of the contract. So in this case, that would be an extra $1.17. That brings us to the total value of this contract. There we go. That's where the $1.34 comes from. So that's the current price of the contract, but that value is going to change according to a series of variables. And really, it comes down to three very significant variables, and then one more that's a little bit kind of nominal, and you'll see why. But all of these variables can be measured by something known as the Greeks. And for the Greeks, we're going to be looking at delta, gamma, theta, vega, and rho. And each one of those tells us something very significant about the different elements that add up to the current value of our option and the future value of our option. So first of all, let's talk about delta. And in order to see this, I kind of cheated. I already have all of those added here. That's not very fair. Let me show you how I added those. So let's switch this back to what would be kind of a default column set. So by default, we typically be looking at the last price of our options and the net change since yesterday's close. Last price and net change. I'm going to switch those to the Greeks. Now, here's how we might do that. If we go to the default column headings, that'll give us delta, gamma, theta, and vega. So let's just choose those Greeks. But I want to add one more. I also want to discuss rho today. So let's click on that. Let's customize the existing set of those four Greek columns. And we're going to look up rho. There it is, RHO. Let's add that as a fifth Greek here, and then just click OK. There we go. Now we have delta, gamma, theta, vega, and rho. And each of these have a decimal value there, 48, 13. Let's look at our 50. 54, 13, minus 6, 3, and 1. And notice that some of these are positive, some of these are negative. An important initial assumption regarding our Greeks is that it places us in the role of the options buyer. Okay? It always assumes that we are buying the option. In this case, we are. We're buying the 17th of October $50 call. So excellent. No changes that we need to make to the Greeks. There can be important changes. I'll tell you that toward the end of today's presentation. But we can just use these at face value. So let's tackle delta first. So delta, this is what I like to use a little word association here for each one of the Greeks. Delta starts with D, so does dollar. Our delta tells us how much our contract will change in value according to a $1 move on our stock. So if the stock goes up $1, that delta shows us how much the value of the contract will change in reaction to that. If the stock goes down $1, this tells us how much we will lose. So E. Dunny says, what would be different if you were the seller? Should I just skip right to that point, E. Dunny? We would reverse all these. All the positives become negative. All the negatives become positive. That's it. Okay? But just staying with assuming that we are the buyer of a contract here, let's say that we're looking at that $50 call. It has a delta right now, positive 54. And it's accurate to say 54 cents. So what does that explicitly mean? Well, let's say that we buy the contract right now, and then the stock just pops up, just like what we thought. It's sitting down here at about 50 bucks. Let's say it rockets up to 51 almost instantly. Is it likely to do that? No. Could it do that? Yes. Could be a news announcement or something like that comes out. No, you're fine. All right. So what this is telling us is Delta tells us if there's a $1 increase in the value of the stock, our option increases in value by 54 cents. So if we started off with a $1.34 value and the stock pops $1, we just made a 54-cent unrealized gain, and it is an extremely accurate number. It's exactly how the contracts are determined in their value. So $1.34 value now becomes a $1.88 value, 134 plus 54. Well, what if the stock drops? A $1 move downward. Now we lose 54 cents and our contract goes from $1.34 down to 80 cents in value. And that shows you the real leverage on this contract. Our stock has only gone up $1, which is a 2% move on a $50 stock. And yet our contract has gone up basically 30%. Is that about right? It might be more than that. Let me do some quick math here. Calculator. If we take a 54-cent increase on a $1.34 investment, that's 40%. Yeah. So that shows you the degree of leverage here, how much this call is delivering. When you hear about options having a lot of leverage, that's another way that Delta can offer some value to the trader, because they can show how much we might make or lose in a dollar amount, but it also directly implies how much might be made or lost as a percentage. That's a ton of leverage. In any case, that's Delta. So Delta starts with D, so does dollar. Now, I'm tempted to go through this from the seller's perspective. I'm not going to do that just yet. Let's look at Gamma. Gamma, okay, we did some relatively light lifting with Delta. I will say with Gamma, it kind of has a reputation for being possibly the most complicated Greek, although as we discuss it, you'll probably say, that's it, Cameron, that was as complicated as it is. Yeah. Here's what Gamma stands for. The way that I think about it is Gamma starts with G, so does growth. Gamma is the rate of growth to Delta. That sounds a little bit goofy, but here's what actually happens. As our stock goes up in value, our contract, it becomes more valuable. And as that contract price grows, it grows at an increasingly faster clip, basically. And Delta tells us how quickly Gamma grows. So let me just say that in mathematical terms. Let's say our stock goes up $1, and we know that we bought this call for $1.34. After a $1 move, it's worth $1.88. So it's a more valuable contract. And as a bigger contract, it now has it can grow exponentially faster up to a point. Okay. Well, I want to ask our veteran traders here, what if the stock went up a second dollar? You might think, oh, well, then I'd add another 54 cents. No, actually, we don't add 54 cents. That would be the same initial rate of growth, which would mean that we're slowing down in our growth. 54 cents on a $1.88, not as strong as 54 cents on a $1.34. Actually, what we would do is add in Gamma. So on that first dollar, we make 54 cents. On the second dollar, we make 54 cents plus 13 cents. So we would expect a 67-cent increase from that second dollar of growth. Okay. So that's Gamma. So to explain that, let's just sort of bottom line it. We buy the stock or the contract for $1.34. Stock goes up $1, add 54 cents. Stock goes up a second dollar, add another 54 cents plus 13 cents. So we're growing even faster. So that's Gamma. So if you struggle with that one's a little bit heavier lifting, but just think it is the rate of growth at Delta. Delta gets bigger. That's how much bigger. Now there's a cap to delta. How big can delta get before it stops? Well, it can't go above $1. Our call contracts don't offer the potential to grow the contract faster than dollar for dollar on the stock. So our delta grows up to $1 and then it stops. That's it. It'll continue just increasing value. The contract will continue increasing value at $1. Phil says gamma is a constant, so $1.03 of increase. Will gamma stay at the same, or does it change too? Good question, Phil. It changes. So what Phil is asking is, delta always 13 cents at this strike price? No, delta actually, gamma slows down as we get closer and closer to $1. So if I were to expand out the number of strikes here, let's maybe put in 60. I don't know how many it's going to take to get up there. Yep, you'll see our delta is getting closer and closer to $1 as our strikes go deeper and deeper into the money. And that causes our gamma to just diminish really dramatically. Yep. So good question. I hope that addresses that question. So what's our gamma? Let's put in a plus 13. Now let's talk about theta. Theta is the time decay effect. Theta starts with T, so does time. This shows us our rate of exposure to the passage of time. So let's say that we buy a contract on day one for $1.34, and then nothing else changes. Really quiet day on the markets. Nothing else changes. 24 hours goes by, or maybe it's just the weekend. We go through Saturday. We go from Friday to Saturday. Nobody's trading. Nothing else is happening. Our theta tells us the impact of that time decay. When we buy this contract, there are 10 days on it. After one day, there's only 9 days left for the stock to do something. That day carries a specific numerical value. So how much would our contract be worth on day two if nothing else changed? Well, this is a negative number. We would subtract this value from the contract value. So if we bought it on day one at $1.34 and nothing else changed except the passage of time, our new contract value would be $1.28. That's it. So theta starts with T, so does time. Now we're looking at Vega. What is Vega? Vega, all right. Gamma is probably our most mathematically complicated. Vega also requires a little additional understanding of the way that options are priced. So I'm going to go back here to the way our original price was determined. $1.34, that's the current value of the contract. And we know that we're getting a 17-cent discount. We know that we get a fixed price for 10 days, but not all 10 days are built the same. Let me tell you that options buyers typically really like a nice volatile stock. Options buyers do not typically like pure stability. In other words, a stock that doesn't do anything. If we bought a contract on a stock where we have the right to buy the shares for $50, but they've been at $50 for the last year, and everybody expects the stock to be at $50 for the next year, that contract doesn't actually hold a lot of value. So what? We have the right to buy the stock for $50 and it doesn't look like it's going to change in the next 10 days. Those contracts are not going to be worth a lot. And that's because of the volatility element. Stocks that are more volatile will tend to have options that are more valuable, higher priced, because they carry more potential on a per day basis. You know, to exaggerate things, let's say that we're buying this, let's say that Bank of America, over the last 10-day stretch, went from $20 up to $100, down to $80, and was just all over the place. Well, heck, if the trader's timing is good on a stock that moves that much, they might lock in a price of $50. And if it rallies up to $70, $80, $90, that's a ton of potential. And so they might have to pay for that potential in advance. Now, on the other hand, if that potential bleeds off, if it was just really volatile because of some big event, and traders are not expecting much movement over the next 10 days, that quieter volatility will lower the value or the price of the option. So Vega starts with V, so does volatility. It accounts for the volatility element here. So when we see a 3, as we do, let's put on our theta value before we move on here. So this was a -6. Our vega is a +3. What this is telling us is that if expectations for volatility change, then this contract will become more expensive. So volatility expectations are constantly in flux, rising up and falling down. And as volatility expectations change, it influences the value of options. So in other words, if the expectation and the assumption here on volatility, the assumption is that volatility expectations increase by 1% for the time frame of the contract. Well, if volatility were to rise 1% here, that would actually increase the value of the contract by 3 cents. If volatility were to drop by 1%, that would decrease the value of the contract by 1%. Quieter stocks just have less expensive options. More volatile stocks have more expensive options. Okay, so there we go. That's our volatility, or vega. Finally, we have. All right. All right. So playing that same word association game again, if delta starts with D and so does dollar, if gamma starts with G and so does growth, if theta starts with T, so does time, vega starts with V, so does volatility, what do you suppose R stands for? R, rho starts with R, so does rate. In other words, interest rate changes influence the prices of options. Now that's academically interesting, but in real trading reality, it tends to be a very, very nominal impact. So here's explicitly the assumption of rho. Rho assumes a a 1% increase in the interest rate. How often does that happen? When was the last time we had a 1% increase in an interest rate? That typically happens very gradually over long periods of time. And even then, how much of an impact would be expected? A 1% increase in interest rates would result in a 1 cent change in the contract value. So it is nominal. It's not zero, though. And as an educator, it's important for me to explain what rho is, because just as part of the pricing algorithm, why in the world do we need to account for interest rate changes? Well, this whole pricing model was first introduced by some gentlemen named Black and Scholes. Those are their last names. But in any case, there used to be a bit of a struggle for options traders just in the trading of options, because you might have trader A who says, hey, I have a stock, it's priced at $50. I want to sell a contract for 10 days with a strike price of $50. And someone else would say, I have a different stock that's a $100 stock, and I want to sell a 15-day contract. Well, how do we price these things? So Black and Scholes came up with a model for the pricing of options that standardized that pricing, and it included an element to accommodate for what's known as opportunity cost. If we go spend $134 on this contract, that means we have $134 conceptually less that we might spend on something else. We might go buy something highly speculative that carries a lot of potential, but also carry a lot of risk. But we're missing out on other investment opportunities for the time frame of this contract. And so that needed to be built into this model. Now, it's not really probably terribly realistic to say, hey, Cameron committed $134 to this trade and he missed out on some investment that was going to explode in the next 10 days. But what's a reasonable assumption here? Well, maybe he could have taken his $134 and given it to government for 10 days and gotten a return that way and earned a little bit of an income there. So the interest rate is reflected in the opportunity lost, or in other words, the opportunity cost here. So that's what that is accounting for. And you can see why it's not a huge opportunity that's being missed, So it doesn't need to have a strong adjustment in the pricing of this contract, something to accommodate for and to compensate for that opportunity cost. But that's rho. It starts with R, so does interest rates. But each of these can help the trader start to anticipate. Kevin says, Cam, when you're talking about a 1% change in interest rates, you're talking about 1% change in the current rate or 1% point change in the current rate. Sorry. Yes. Good call out, Kevin. Yeah. Sometimes I misspeak. I know what I'm trying to say in my head, and it doesn't actually cross the teeth and the tongue correctly. It is a 1 point change, not a, well, yeah. If that's helpful to you, so if current rates are, let's say 4%, and that's increased to 5%, there you go. Does that help? Percent or point, however you want to phrase that. But bottom line is this really truly tradable knowledge now that we have it? Probably not. It's still important for me as an educator to cover that ground. But for the most part, traders will focus most of their time and energy on these first four Greeks: delta, gamma, theta, and vega. And they might not be faulted at all if they don't even have rho displayed here on their columns. So let's put in rho here, because I do want to go through a little process, just a little pop quiz. Now that we've been introduced to the Greeks, I want to talk through a little exercise using Bank of America as our hypothetical here. Let's now suppose that our stock, let's say that it goes from, all right, it's about 50.5, right? And going up to 52.5 would be about a $2 move to the upside. Let's just round it off to $2, not make this too complicated. We're not going to worry about the pennies. Let's say the trader expects the stock to go up $2 over the next 5 days. So that's calendar days, not just trading days, but calendar. Weekends count, okay? Up $2 over the next 5 days. And let's say that during that time, let me see, do I want to make this? Yeah, let's throw in a volatility assumption. Let's assume that our volatility expectation on our stock goes up 1% during that time. What would be the new value of this contract? If we paid $1.34 for it, this is important. What would its value be 5 days from now if the stock is up $2 and if volatility has risen 1%? So here's how we might calculate that. We start off with $1.34. A $1 move on our stock might give us a 54% increase in the value of the contract. That's the first dollar. The second dollar move on the stock is an additional 54 cents plus what? So this is our delta. Our delta shows us how much a dollar move increases the value of our option. The second dollar, we add in gamma. So that would be plus an additional 13 cents. What about time? Well, 6 cents lost over a 24-hour period. We're talking about 5 24-hour periods. So our theta is going to be approximately 30 cents lost to the passage of time. When we kick this trade off, it had 10 days on the contract. 5 days from now, it's only going to have 5 days left on the contract. So only half of the time value is remaining. Now, finally, what about volatility? Let's say that our volatility has risen 1%. Well, an increase in volatility, let me get the right one highlighted here. Our vega starts with V, so does volatility. That would increase the value of this contract by 3 cents, because greater volatility delivers greater potential on the contract, and therefore the contract is more valuable. So what would be the new value of the contract? $1.34 plus 54 cents twice, that's going to be $1.08. So what are we up to then? $2.42 plus 13 cents would be about $2.55, minus 30 cents would be about $2.25, plus a final 3 cents would be about $2.88. Did all that in my head. I shouldn't do that because I run the risk of messing it up. Let's do it up here on our calculator. Okay, so we had $1.34 plus 54 cents plus 54 cents plus 13 cents for gamma plus, I'm going to do it this way, 3 cents for volatility minus 30 cents for time decay, 228. Yep, there we go. Jay Richardson says, Cam, I missed something. Why the 54 cents price? Because here was our assumption. Stock rises $2 in 5 days while volatility rises. That was the assumption. So the 54 cents here was our delta for the first dollar move. The 54 cents here was the delta for the second dollar move plus gamma. Ambrose says, where does the 30 cents come from? Well, our theta is 6 cents for 1 day. We were talking about 5 days of time decay. So we subtracted 6 cents times 5. That's 30 cents. That's where that came from. And then finally, our Vega volatility rose 1%. That's a positive 3 cents. Now, we could mix this all up. Now, one thing that we can't do is say, what if time went backward? Can't do that. But all the rest of these variables we could change. What if we went up $3? What if volatility dropped rather than rising? What if the stock went down instead of up? Greeks can give us those insights, but it is fairly complicated. Can you grant me that? Somewhat complicated. It's good to know how this is calculated. But now that we understand how it's done, it'd be nice if there's just a calculator that does all this for us, especially if it's, let's say it's going to be $7.50 up over 24 days and volatility is 3% up or 6% down or whatever. There is a calculator that can do all this math for us. So I'm going to show you that in just a moment. But I do want to emphasize something first. What if our interest rate was cut 0.25%? That seems the most likely scenario during a contract period over the foreseeable future, right? Well, a 0.25% cut is going to have a fraction of a penny impact according to our row. So it really wouldn't change. It might change this from 228 to 227.75, something like that. But yeah, row is usually not an enormous consideration when trading. So these are sort of the kings of the Greeks. But now that we know how to do this manually, it is nice that we actually have a calculator right here on the platform. We can access right up here, right up where we were changing our strikes. We can change this from spread to from single to vertical. Right next to that, we can change to what's known as Theo price. So we're going to lose our Greeks here. That's okay. We don't need them. They're going to be wrapped into our Theo price calculator. So when we choose Theo price, this is actually a calculator that lets us put in all of those movement assumptions, those variable assumptions. So I'm going to click on this Theo price calculator here, and let's just plug in our assumptions here. Well, our trader was expecting a $2 move up. So let's just put in a positive $2 here. In 5 days, that would put us out here as of today. This is Tuesday. That would put us out on Sunday. Okay. And we were expecting volatility to increase 1%. We can just put those in our calculator. And what that immediately does, as we put those parameters in, it gives us a column over here titled Theo price, and it's the theoretical future price according to our assumptions. For our $50 contract, ooh, look at this. We bought it for $1.34. It's actually worth about now $1.44 because things are on the move. But our expected future value at this point would be about $2.57. So it's just plugged in those same variables. and calculated the new expected value. And this is extremely accurate, assuming our assumptions are accurate. Obviously, we might expect the stock to go up $2 in 5 days, and it actually goes down $1 in the next 5 days or something like that. So yeah, that calculator can be very handy. The point that I wanted to make here is that if a seller is trying to calculate their anticipated returns, it's just going to invert all of the assumptions the buyer makes. So if the stock goes up $1 and the buyer makes an unrealized gain of 54 cents, guess what happened to the seller? They have an unrealized loss of 54 cents. If a day goes by and the buyer loses 6 cents, where does that 6 cents go to? It doesn't just disappear into the ether. It actually becomes an increase in value to the seller. So time decay is positive for the seller, negative for the buyer. And the Greeks are always just displayed as under the assumption that we're the buyer. Hope says Delta is my favorite Greek. I don't think you're alone in that sentiment, although it's not universal. Actually, there are plenty of traders who maybe emphasize, let's say, theta as their most important Greek. Maybe they're trying to exploit the passage of time decay since they see that as the most predictable of the Greeks. But in any case, guys, that is your sort of detailed introduction to the Greeks. And I think you can see how important this is for understanding what we are now paying for on a contract and how that influences future expectations for contract values. Now, this is something that's going to take a little bit of repetition. If you need to go back and listen to this webcast again, it's going to be recorded and added to our archives unless there's some sort of a technical glitch. But that is a reminder that if you haven't subscribed to our Trader Talks channel on YouTube yet, make sure you do that right now. You can go down and click on the subscribe button. It only takes a second. It doesn't cost anything. But our YouTube channel is where we house these webcasts after the live stream is concluded. So just look for Trader Talks Schwab Coaching Webcasts on YouTube, and you go right here to playlists. And like for this webcast series, Getting Started with Options, there are a bunch of different playlists for a bunch of different webcast series. You just scroll right down toward the bottom. Second row up from the bottom is my Getting Started with Options. You can find the full playlist by clicking on View Full Playlist right here. And there's last week's discussion. Strike selection is vital when trading credit spreads. Why is it so vital? We've talked through that. Also want to give an invitation to you to follow your favorite presenters from Schwab on X. If you have an account on X, you should be following your favorite presenters there. It's the best place to connect with us in between these live streams. You can follow Kevin there at Kevin Horner CS. You can follow me on X at Cameron May CS. So as an example, I recently just posted this. This is sort of a flashback to my childhood. Elon Musk, for just a moment, was the world's first $500 billion person. And it reminded me of the $6 Million Man, that TV series from the early 70s. And my mind was blown as a 5-year-old that something could be worth $6 million. Yeah, and now Elon is $500 billion guy. Anyway, yeah, if you reply to one of my posts on X, I try to reply right back to you. It's the best place to connect with me. So yeah, give us a follow there at Kevin Horner CS, at Cameron May CS. Everybody, thanks for joining me today. I can see 180 people watching the live stream. I can see, 59 have already clicked that like button. Make sure if you watch the webcast and if you enjoyed it, click the like button. It's a nice pat on the back to the presenter for their efforts. It also gives a boost to that presenter's video in the YouTube algorithm so more people can find these sorts of discussions and learn about things like how options Greeks are vital in understanding the pricing of options. All right. Kevin, thanks for helping out in chats. Everybody, I'll let you go enjoy the rest of our webcast through the rest of the day. I will see you in a future webcast. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.